What's good, everybody? It's Vaughn, and this is where you get that knowledge that you don't get in college. Go ahead and scroll into the description, click the link next to WeBull, and collect your 12 free stocks. So today, I want to talk to you about these banks, because these banks ain't banking the way that they supposed to. They got the cheese and they don't want to give it out.
Amid the decline in lending and bank deposits at small banks, U.S. credit conditions have fallen to post-pandemic lows, according to the American Bankers Association. Furthermore, U.S. credit conditions are expected to deteriorate in the next 6 months to their worst level since the pandemic, according to a survey of chief economists at 15 of the nation's biggest banks. Taking all that into account, banks could see lower quarterly earnings and a weak 2023 outlook this earnings season.
But since I'm that guy, I'm going to tell you why. So last month I made a video about the Silicon Valley Bank failure.
SVB Bank has now failed. It is the first insured institution to fail so far this year. Again, SVB Bank has officially failed.
Even though the Fed came in and they said that they would insure 100% of the depositors' funds, Silicon Valley Bank customers withdrew $42 billion in one day, leaving the bank with a negative cash balance of $958 million. When a bank has this many depositors withdrawing funds, it can cause them to sell assets at a loss just so that they have enough cash. During the week ending March 15th, $98.4 billion was pulled from U.S. banks. Then the following week, depositors withdrew $126 billion. As a result of this, in the last 2 weeks of March, bank lending has fell by a record $104.7 billion, which is the most on record since 1973. The biggest 25 banks account for almost 3/5 of lending, although in some key areas, including commercial real estate, small banks are the most important providers of credit. We are already starting to see prices of commercial real estate plunge, and now Morgan Stanley is warning that the drop that we will ultimately see could be worse than the financial crisis of 2008. Investors have sharpened their focus on this sector, giving regular banks significant share in commercial real estate lending. However, commercial real estate was facing risk from long-term trends, with remote work threatening the office subsector, even before the banking industry turmoil. In the next few years, commercial real estate will experience a refinancing war due to the fact that more than half of the $2.9 trillion of commercial mortgages will be up for refinancing. This credit crunch will have enormous ramifications for the economy. When people have less credit, they spend less money, which leads to businesses making less money, causing them to get rid of workers. When workers get laid off, they get behind on their debts, which causes more stress for the banks.
Joining us now to discuss is the Fed guy, blogger, and monetary macro chief investment officer, Joseph Wang.
The main question is here, the potential economic impact of banks tightening their lending standards. Can you talk us through that? I mean, you talked a little bit about that, about business growth and creation. Can you talk us through that a little bit more about the potential effects?
Sure. So banks create money. That's their thing. It's not so much that they take deposits and lend them out, but they create money out of thin air. So when you have very strong bank loan growth, what you're doing is you're adding money into the economy. And when you have more money, you have more potential purchasing power. People can go and buy houses, invest in their business, and so forth. So looking at credit growth is a really important leading indicator for how the economy will perform. So if you think back last year, there's tremendous amounts of bank credit growth, far above what we would expect in a typical year. So not surprisingly, we had pretty inflationary economy, and economic growth was pretty well sustained. Now, going forward, if banks are closing down, battening down the hatches, and not making as many loans, and that doesn't bode well for the economy. There's going to be less money, less spending, and it would help accomplish the Fed's goal of dampening down economic activity and inflation. But there's always the threat of perhaps it having a bigger effect than anticipated and pushing us into a recession.
Yes, so something to watch very closely. Thank you so much for your insight on these topics. Joseph Wang, thank you. Fed guy, blogger, and monetary macro CIO.
So if you haven't realized already, we're in a big bubble that keeps on getting propped up by the Federal Reserve pumping money into the economy. However, what they're doing is just creating a bigger problem and pushing it further down the road. So when the bubble does burst, it's not going to be a pleasant sight. So with everyone pulling their money out of the banks have to tighten up on their lending. And that's going to have a negative effect on our economy. The main lesson that I'm learning from what's going on in the economy is that more money isn't always the solution. You can give a man a fish and feed him for a day. You could teach a man to fish and feed him for life. Once again, I'd like to thank you for your time. If you have any questions, go ahead and leave them in the comments below. If you like this video, go ahead and give me a thumbs up. And don't forget to subscribe and click the bell so that you're notified every time that I make a new video. Until next time.